how can you pay yourself from your LLC? That's the question I'm going to answer in this long format video, where I'll answer this question quickly and then go into the detail of some of the nuances of, based on your entity type, your structure, your income, and your projections for the future, can affect your strategy about how to pay yourself from your LLC or corporation. I'll discuss that a little bit later, because it is possible that you have an LLC, that you're an owner of an LLC, but you make the election to be taxed as a corporation. So you must understand the default treatment of paying yourself as a single member or multi-member LLCs, which is a standard LLC per se, or what if you make the election to be taxed as an S corporation or a C corporation. We will discuss that in detail. Now, there are 3 ways you can pay yourself from your LLC. One of them, and the most typical one, it's called the owner's draw. That's when you just write yourself a check. You don't make any tax withholdings. The LLC is paying you, the owner or one of the owners, a distribution check, a draw against the profits of the business. The other way you can pay yourself is with payroll. Pay yourself through a salary. You will withhold taxes, and you will have an entire system in place to pay yourself, withhold taxes, send those taxes to the government, file forms, and so forth. And the third way you can pay yourself from your LLC is called a dividend, which has optional withholding. You actually don't need to withhold on a dividend, but you can if you want to. Now, the entity type that you choose or how you structure your LLC actually affects how these payments are made. So let's talk about what the contents of today's video. So we're going to discuss a lot of things in detail. I gave you the 3 ways to do it, but now I'm going to explain the nuances that you need to apply to your situation to figure out how you're going to pay yourself. So first, we're going to discuss the difference between owner's draw, payroll, salary, and dividends, which we just talked about. Then we're going to go into the detail of each entity type. And I want you to think about an LLC as of being potentially one of 4 entity types. It can be all 4 of them. It can be 2 of them. It can only be 1. So you're going to make the election based on your situation. So the default way an LLC is when it has a single owner is called a single member LLC. Pretty easy to remember. You're going to file 1040 in your Schedule C. If you don't do your own taxes, that's something your accountant worries about. But you want to know how to pay yourself if you happen to have a single member LLC. We're going to start discussing that in detail. Secondly, we'll talk about calculating the liability. Single member LLCs don't pay taxes. Multi-member LLCs don't pay taxes. It is the owners of the LLCs that pay the taxes in representation of the LLC. So we're going to discuss more or less how the liability is calculated. Then we're going to move on to multi-member LLC. That's an LLC that is owned by 2 or more people. You will use Form 1065. Again, if you don't file your own tax returns, something for your tax accountant to worry about. This is often called a partnership. This is the traditional naming convention that we use for association of 2 or more people doing business together, which is basically what an LLC potentially is when it has more than 1 owner. So in the tax return, it's actually called a partnership, even though legally it's called an LLC. Now, we're going to discuss the third entity type, which is an LLC that made the election to be taxed as an S corporation, which would file Form 1120 S on the tax return. And then we're going to discuss the 4th type, which is LLCs that elect to be taxed as C corporations. And C corporations file with Form 1120. Again, if you don't file your own returns, something for your accountant to worry about. This video is focused around how you're going to pay yourself. And the last thing we want to discuss here is multiple entity issues. This is for people that have more than 1 LLC or a combination LLC, S Corp, C Corp, multi-member, single member. So when there's combinations of things, we're going to discuss kind of not so much tax strategies, but some of the structure that is allowed when you have multiple entities. So let's dive right in. Now, depending on how you pay yourself, the type of payment actually affects the type of form you're required to file to the IRS. So for example, if you have a single member LLC and you pay yourself an owner's draw, there's actually no reporting requirements. When you report the income and expenses of your single member LLC, that's going to go in your personal tax return, and the amount you paid yourself or didn't pay yourself is not reportable. Only thing you report is income and expenses. So single member LLC, easy, nothing to worry about. If you didn't make any special elections, there's no reporting requirements. You just have to, in your Schedule C, put your income and expenses, and that's it. Now, if you have a multi-member LLC, this is an LLC with more than one owner, you are going to have a form called a K-1, which goes inside your partnership tax return, or the Form 1065 that we talked about. And in that form, you're actually going to see the reported amount of draws or distributions that you took. So there will be a beginning balance of the capital you put into the business. There will be an increase or decrease in capital based on the profits, and then the final decrease in capital based on how many draws you took out. What's interesting about this, we'll discuss this a little bit in detail, is because there's multiple owners, every owner gets the K-1, and every owner has its own calculation on those owner draws. We'll discuss that in a little bit more detail. Let's talk about payroll salary. So typically only when somebody has a corporation, an S corporation or a C corporation, they start worrying about paying themselves through payroll. We'll discuss it in detail. This is actually a requirement, a minimum requirement on S corporations, and it's sort of quasi-optional on C corporations. We'll discuss what that means. And if you have an LLC, you may have made the election to be taxed as an S corporation or a C corporation. So if you made the election, you must pay yourself at least a big chunk of that payment through payroll via a W-2. That's the form that ultimately gets reported to the IRS that represents the amount you pay yourself through payroll. With S corporations, you can have both. You can have payroll and owner's draw or distributions. With C corporations, you can have both payroll and something called a dividend. A dividend is only for C corporations, and there's a form, is a 1099-DIV, which is the one the corporation or the LLC converted to a corporation for tax purposes needs to file at the end of the year to let the IRS know that this owner received some dividends. So based, again, as we talked about earlier, based on the entity type, the way you pay yourself and the way you report what you pay yourself, and as we dig deeper, the way you pay taxes on how you pay yourself all changes. Now, I want to make a quick note. You're going to hear me say the word owner, partner, member, or shareholder. I'm using all those things interchangeably. It all means an owner of the LLC. Now, the terminology is typically based on the entity type. So a single member LLC is typically just called the owner. A multi-member LLC is typically called the member or the partner. A LLC elected to be taxed as an S corporation or a C corporation is simply just called a shareholder. But if I happen to say shareholder when talking about a partnership or partner when talking about a corporation, I essentially mean the same thing. All these terms are used interchangeably, and it's okay if you get it wrong as long as you understand what is trying to be communicated. Now, what exactly is an owner's draw? And I'm just going to simplify this. An owner's draw or a distribution is when the owner of an LLC just takes money out of the LLC and puts it in their personal bank account. Maybe they write themselves a check, no tax withholdings, just a straight check. Maybe they take cash out of the business. Maybe they distribute value from the business, like they take a business asset and make it their own. That is called a distribution. And it's only called a distribution when it's above and beyond the amount of the initial investment. So if I'm an owner of a business and I put $100,000 to start my business, the first $100,000 I take out is basically just me taking my capital back. That's not a draw yet. That's just the reduction of my initial capital. And it becomes a draw, or at least within the context of this video, it becomes a draw when it's beyond your initial capital. You will also hear the concept of equity. Equity and capital are the same concept. Again, that's the money that you as the LLC owner put into the LLC. Now let's start with single member LLCs, the most common type of LLC in America. I started my business on my own. I created an LLC so I operate under my personal name, and I'm running a business. A single member LLC is an LLC formed in any state that is owned by a single LLC owner, by a single owner. Now, if you don't make a special election to be taxed as a corporation, an LLC will always by default be treated as a single member LLC, which means that you file the tax return on your personal tax return. You can pay yourself an owner's draw whenever you want. You can pay yourself whatever you want. And there's a little asterisk there, which we'll discuss in a second. You don't need to withhold any tax in those payments. The payments themselves are not taxable. There's no tax attached to the payment. Although, again, we're going to discuss the asterisk in a second. What gets taxed ultimately is the profits of the business. So your income minus your expenses. And because you're being taxed on the profitability of the business, not the distributions, you have to make estimated taxes based on that profit. Now, I did make a little asterisk there because you can take out owner's draw. Again, no tax attached to it, no tax liability directly attached to the draw, as long as the draw is not above and beyond your capital. We'll discuss capital in a little bit later. We'll dig into that. But basically, it means you're not going to take new debt. You're not going to take a loan just so you can pay yourself. So as long as you're not doing that and you're paying yourself from the profits of the business that are being taxed, then you're going to be okay. There's not going to be any additional tax on the owner draws that you take. Now, how much tax will I pay? And that's a really good question, and it actually matters on your personal tax situation. So I'm going to put a link in the description to the latest tax bracket. What you're seeing on the screen, which is what I used when I recorded this video, is the 2022 tax bracket. But if you're watching this in the future, it's important for you to see the most updated tax bracket. Now, I'll just give you a general idea. Let's just focus on $100,000. If you're a single taxpayer, you're not married, and you make $100,000, and you look in this box, you look in this chart, you are at the 24% marginal tax bracket. That means that the first 10,000 pay 10%, then the next between 10,000 and 41,000 and change pay 12%, between 41 and 89 pay 22%, and anything above 89 pays 24%. And that's how you read tax brackets. It is a step system. Like, you don't pay 24% on everything, you pay it just in that bracket. Now, there's one little caveat here that's really, really important. So even though the income tax brackets vary between 10 and 37, there's actually a little bit more tax to be paid. So there's a tax called the self-employment tax, and it's designed to cover for Social Security and Medicare. Regular income tax doesn't fund Social Security and Medicare. Employment taxes fund Social Security and Medicare. If you've ever been employed, you know your paychecks are not whole because you're paying Social Security and Medicare. So what self-employment tax does is it calculates the amount of Social Security and Medicare that you have to pay to the government, which is actually 15.3% of that business's income. So that's a pretty big number to think about. And there are some limits to, you only pay that in the first 140, 150,000, and beyond that you pay a much smaller amount. But for most taxpayers, 15.3% of the first $150,000 that they make, it's a pretty big number. So you have to add that self-employment tax to your tax bracket. So you're paying both taxes. So it could get pretty steep. And this is where a lot of people think about the S Corporation, which we'll discuss briefly, which is sort of the point of this video. It's not to give you a straightforward answer. It's to get you thinking about your options, because the decisions that you make could affect how much taxes you pay. Now, there's something called passive income, like real estate rental. So maybe you create an LLC because you have a real estate property in there, and the income you're deriving from it, it's passive income. Then that's different. That does not pay the 15.3%. So if you're watching this because your LLC only owns a piece of real estate, and you're asking yourself how to pay yourself from your LLC that only owns real estate, then the answer is an owner's draw. Forget it. You don't have to complicate yourself with much. Single member or multi-member LLC. But if you don't have real estate in that property, in that LLC, and the LLC runs a business, an ordinary business, then you will pay that 15.3%. So that's why I'm making that little nuance there, because it's important for you to know that there's self-employment tax in certain income and not in others. Now, one little tiny thing to add here is if you have a single member LLC and you are the owner of that single member LLC, and you want to just like a really simple ballpark of just putting money away out of all the money you make from your business, don't do it based on how many distributions you take or how many draws you take. Do it based on the profits of the business. So generally, what I would do, rule of thumb, if you make less than $150,000 a year, I would put away about 28%. And if you make more than $150,000 a year, I would put away about 32%. That's 28 or 32% of the net. Again, this is just an estimate. This is not a calculated amount, and the number that pertains to you might be different, right? So you want to put away enough so at the end of the year, you can pay your taxes on the profit of your business, which is irrelevant to how much money you take out. But I know that the purpose of this video is for you to know kind of both things. How much can I take out and what are my tax implications? Okay, how do I pay those estimated taxes? So most people have a single member LLC and they say, Hector, great, I'm going to tuck away 28%. How do I pay that? Well, it actually gets paid quarterly. And you can do that through the IRS website, or you can send a check. I prefer to use the IRS website. That's the best way to do it. You can pay via ACH, a direct bank payment, or you can pay with a credit card. They will charge you a couple of points of percentage if you pay with a credit card because there's a transaction fee. Now, the payment schedule for your estimated taxes should be the entire liability for the year that you think is going to be. So that profit times that 28% or 32%, again, just a ballpark number. You can go back to the chart and the tax bracket and get the exact number, of course. And you're going to pay for the first quarter, April 15th, second quarter, June 15th. I know it's weird. They're not perfect quarters. Third quarter, September 15, and lastly, the fourth quarter gets paid on January of the following year on January 15th. So through the tax year, you're going to estimate how much you're going to make at the end of the year, and you're going to make payments. If you don't know how much you're going to make, then you can estimate zero, but then you could pay a penalty for not prepaying those taxes. So to be safe, kind of take a look at the previous year and try to mimic that. Or as quarters progress and you have more and more information, start equalizing that payment. So again, by the time January 15th comes along and the year has already passed, you have the opportunity to make whole in that fourth quarter. Now, how do we calculate that number? So like I said, we could think of a number like 28% or 32%, but how do we actually calculate it? So this is how you do it. Pretty simple. You're going to take all your sales minus your business deductions. And business deductions, it's a kind of a complex topic. I'm going to put a link in the description to the top deductions you can take for your business. So it will be a perfect video for you to watch after this to say, well, okay, what can I deduct from a business? Different topic altogether. We take all of our income, all of our sales from a business, deduct the business tax deductions, and now we get our taxable business income. That's it. So that's our taxable business income or our net profit from a business. Then we're going to take that taxable business income and we're going to multiply times 15.3% so we can figure out what our self-employment tax is. Again, single member LLCs, multi-member LLCs, they are going to pay this self-employment tax unless your business is passive like real estate. Then you're going to take your business income, right? Your non-business income. So if you have a regular job or a spouse that has a regular job, you're going to add those two things together. You're going to take out your personal deductions, and I'll put a link on the video, on the description as well to talk about personal deduction. That's a different topic. Then you're going to multiply that times your tax bracket, and you want to look at the tax bracket. Again, we'll have a link in the description for that, and you'll figure out more or less what your income tax is. Then you have to add the two things. You have to add the self-employment tax and the income tax together, and then minus what you've already paid via estimated taxes or what you already got withheld through a W-2 payroll or through some other mechanisms. It's a lot more complex than this. I am oversimplifying it. I'm just sort of assuming that that you are watching this because all your income is derived from the LLC, and that's the simplest way to look at it. But of course, everyone's situation is different. Now, again, as mentioned earlier, these brackets vary between 10, 12%, all the way to 37%. You want to take a look at that bracket. We'll put a link in the description for that. Now, the mechanics of this is you come up with that number, the entire liability for the year, and you simply divide it by 4. That's it. Divide it by 4 and pay it on the dates that we discussed earlier. Now, let's go back for a second. How does the owner's draw affect the tax liability? Well, the answer is it doesn't. That's the point I'm trying to make. Tax liability on single member and multi-member LLCs are solely made on the profit of the business. There's a little tiny nuance, which is what if you distribute yourself more money than what you have in capital? As I mentioned earlier, that might be when you take out a loan and you use that loan to pay yourself, right? So you take out debt to pay yourself. But most of the time, if you're paying yourself from the profits, your capital is being increased by those profits, so you will not have an issue with this calculation. Now, how does my capital or equity into my LLC affect my tax liability? So the answer is none. Again, repeating this. As long as you don't take non-recourse debt to pay yourself, that's a loan that you don't have to pay back, then you're not going to have any issues with this. As long as you don't take out debt to pay yourself, you should be okay with your equity or capital accounts. Now, what about loans to owners? Can you give a loan to an LLC owner? Sure. A single member LLC can lend the owner whatever they want, whenever they want. For the purposes of taxes, a loan to an owner is the same thing as capital or distribution. So just think of it as all the same thing. It doesn't matter if you call it a loan or call it a draw. At the end of the day, for single member LLCs, it means the exact same thing. Nothing is affected by that situation. Now let's switch over to multi-member LLCs, LLCs that have more than one member or partner, and they didn't elect to be taxed as a corporation, and they're filing a Form 1065. Same situation as a single member LLC. Owners can pay themselves owner's draw whenever they want, whatever they want. LLC doesn't need to withhold tax on those payments. The payments themselves are not taxable. The profits of the LLC are taxable, and the partners individually have to make the estimated tax payments individually based on their own tax situations. So nothing changes from single member to multi-member LLC. However, the limitation of capital, it's per owner. So you may have one owner that put in a lot more capital in the LLC than the other one. And as they start taking money out, it's possible that one owner is still taking away their own money first, and another one is taking draws, and it's possible that one might have a different situation than the other. But how is it, in reality, how is it different? It all sounded like the same. Well, the only difference is this little nuance. We talked about the capital account being accounted for individually and different. But in a multi-member LLC, you can actually assign a taxable business profit percentage or allocation to a different member, regardless of what is their actual ownership in the business. So for example, I could be 50-50 owner with my best friend of an LLC, but we can have an agreement that I'm going to take 100% of the taxability of the income of the business. So my partner or my friend that owns the LLC as well owns half the business, but takes none of the taxable income. Again, regardless of how much capital or we have or how much distributions or draws we take out. The limitation that people can only take as much as they put in or as much as their capital is applies regardless. So if I'm the one paying all the tax for the business's profits, I can probably take more distributions than the other partner without entering that situation where I'm out of capital. Again, this gets a little bit wonky. This is more of a math calculation, something that tax accountants have to deal with. All you need to know is if you are paying your tax because the income is being allocated to you, you're probably going to be okay with taking those distributions without any specific tax consequences. Now, there's a special rule with multi-member LLCs, which I love that it exists, which is you can treat some of the draws as a guaranteed payment. And that changes the dynamic quite a bit. And it's a really useful tool. What the heck is a guarantee payment? So a guarantee payment is when you take an owner's draw, but you actually take it as a deduction to the LLC. You reduce the taxable income of the LLC by that guarantee payment. This is in lieu of payroll or compensation. So I'll give you an example. My friend and I both own the business 50% each. We agreed that my friend, not me, will draw $5,000 a month because that person's working actively in the business. I'm only an investor in the business. I might be passive, I might be active, but I'm not drawing a guaranteed payment. I'm not drawing an amount before we calculate profits. So when we do that, the payment that the other LLC partner gets reduced from the taxable income calculation of the partnership. And then the net of that is what gets split 50-50. So we pay tax on that net profit of the partnership. However, even though I only pay half of the net after the 60,000, my partner is going to pay the net, their half of the net of the business income that already reduced the guarantee payment, but they're going to add the guarantee payment on top of that because it will essentially reduce from the allocated amounts that each of us have to pay. I know, it just gets really hairy. This is just a tool. A guarantee payment is a tool. So you can pay a partner before you count profits. Basically, it's in lieu of payroll. This is for compensation. This is when a partner, it's agreed to do a particular job or takes a particular responsibility that other partners don't. So that's what guarantee payments are used for. That's the tool that we use guarantee payments for. Okay? So that's a really important piece of it. Now, what happens in multi-member LLCs? What about loans to partners or members? Can you do that? Same exact thing as a single member LLC. LLCs can lend members or partners any amounts for tax purposes. It's treated just like an owner's draw. It's treated just like capital or equity. It makes no difference. It does not affect the taxability of it other than reducing that owner's capital account. Now, what about a silent partner? People ask me all this time, what about my silent partner? Well, what's a silent partner? So if a person is not listed as a member or an owner of the LLC or corporation, whatever it is, they will have zero tax liability on the profits of the business, right? Now, if you're paying money, if you're actually paying that silent partner that legally doesn't own the business, it's just there to help or whatever they're doing, any payment that silent partner gets will be taxable to that silent partner, and it will be treated either as interest. So let's say they lent you money and you're paying them, that's interest on the money, or it gets paid as non-employee compensation, which you as an LLC have to give them a 1099 and they will pay taxes on that. So a silent partner basically is just a person that will get paid from your LLC for whatever circumstance it is. And if they get paid and when they get paid, that's when they pay tax. Now, the nice thing about this is that payment, you reduce it from your income because paying a contractor, or a compensation to a non-employee or an interest expense, that's all deductible for the business. So finally, when the LLC owners pay tax, they pay a net of those payments. So again, silent partner really doesn't mean anything. It just means they don't own the business. Now, there's something else called an uninvolved partner, which is an owner or a partner of the LLC that's there to just put capital or to give advice, or they're just not in the business from an operations perspective, but they're in the business legally. How does it work for them? So if you have a multi-member LLC and one of the partners or members are non-operating, they're typically called a non-managing member. They can certainly receive draws, and draws are not subject to self-employment tax, and they're not subject to income tax. But that partner will pay tax on their allocated profits, again, through this K1. The only difference is that they're not paying self-employment tax because they're not earning that income. They're they're earning it from a payment perspective, but they're not working for it. So that would be passive income. So being an uninvolved owner or a non-managing member or a non-operating partner of an LLC allows you to get the income from the LLC, but pay passive income. That means you don't pay self-employment tax. So that's interesting. An LLC always needs to have at least one managing member because who's running it, right? So you can have multiple non-operating partners or non-managing members, but you got to have at least one. And the IRS does look at this pretty tightly because it does circumvent self-employment tax. So you have to make sure you document well the circumstances. Okay, what about foreign partners? This gets a little bit tricky. So what if you have an LLC with foreign partners? Well, if there's a foreign partner of the LLC, there will be a requirement from the LLC to make an annual withholding of the maximum tax rate. So 37% of the profits of the business allocated to the foreign partner needs to be withheld. The LLC is responsible for withholding it and reporting it to the IRS into that partner's ITIN, or individual tax identification number. So a foreign partner of an LLC needs to take out an ITIN, an individual tax identification number, because they don't have a social security number, because the LLC is going to put money in their account. And then each of the individual foreign partners have to file a return at the end of the year, and they're going to pay a tax. It might not be 37%, it might be something lower, and get a refund at the end. So with a foreign partner, it gets a little bit hairier, okay? Now, an unprofitable LLC, an LLC that has no business profits, does not need to withhold anything with or for the foreign partner. So you don't have to worry about that. As long as they don't take out any draws, then the foreign partner, you don't have to report anything specifically. It's just when that profit is reported that you have to make that withholding. Now, how do you calculate estimated taxes as a member of a multi-member LLC? Same as a single member LLC, just at each of the partners or each of the members level. Okay, let's switch gears and talk about LLCs to be taxed as S corporation. These are LLCs that elect to be taxed as S corporations. This is probably the best choice for most LLCs. Now, same concept as a multi-member LLC. You're going to have one or more owners. You're going to file an 1120S tax return instead of a 1065 if it's got more than one owners. Ownership percentage always equals taxable business income percent allocated. With a multi-member LLC that did not elect to be an S corporation, you can have owners that have a certain percentage ownership of the business and a different percentage allocated for income and tax purposes. In an S corporation, you don't get that flexibility. If someone owns 27% of a LLC elected as an S corporation, they will pay based on the allocated 27% of the profits of the business. So there's not a lot of flexibility there. It's all pretty straightforward based on ownership. Now, the beauty of S corporations is shareholders do not pay self-employment tax on the business income. This is the 15.3% we talked about earlier. When you have an S corporation, you don't pay that. So it's magically 15.3% of your taxes go away. So it's wonderful. It's really amazing. There's one little tiny nuance, which is shareholders of S corporations have to pay themselves, quote, reasonable compensation. And reasonable compensation gets paid through payroll, and payroll pays self-employment tax in one way, shape, or form, and also withholds tax. So what the heck is reasonable compensation? This is a term that the IRS put together in order to force S corporations, which have this huge benefit of not paying self-employment tax on the profits, to have to pay themselves something through payroll. Now, the actual amount or percentage is not set by the IRS. This is going to be based on the business owner's determination and judgment and advice from their accountant. And there's a whole bunch of factors. The factors I think about when giving my clients advice about how much it's reasonable compensation, keep in mind, business owners of S corporations are going to want to minimize this. They want reasonable compensation to be as low as possible to reduce the amount of taxes that are paid through payroll, to not pay self-employment tax, but not pay Social Security and Medicare as much. So the game here is that most small business owners that have S corporations want to pay themselves as little reasonable compensation and as much draw as possible to minimize that self-employment tax. So the factors I look at is, one, what's the profitability of the business? If the business has $1 million in profit and the S corp owner does all the work and he or she claims that their salary is only $30,000 a year, well, that's a pretty wide gap. I mean, really? I mean, $30,000 a year performance gives you $1 million in profits. So we make sure that there's no ridiculous gap between the compensation and the profits of the business. The next one is how much distributions is the owner taking out from the business. If the business owner is taking out a lot of distributions above and beyond the profits, I start thinking about moving those draws to payroll to prevent that capital account that we've been talking about all the time to go down. So we use payroll to prevent that. And again, we'll pay a little bit more tax when it's through payroll, but we keep it kosher per se to try to stay within the reasonable compensation guidelines. Now, you also take a look at the average salary of someone doing the job that the owner is doing. So the owner is more of a salesperson, or more of a CEO, is more of a data entry person, is more of a sort of field worker. So you take a look at what the role of that business owner is in that business, and based on how much it would cost to replace that person, that owner, with an outside person, or how much that owner will get paid otherwise by working for someone else, we take a look at that number and we put it as part of out of the 4 factors. And lastly, what is the business operating cash cycle? So you can have a business that's very profitable but not very cash rich, where the profits are sitting in accounts receivable because a big customer hasn't paid you yet. Well, the IRS understands that you're going to forego a little bit of payroll for the purposes of helping your business's cash flow. So there's no one size fits all. We look at all 4 of those factors, and that's how we determine or recommend what reasonable compensation to pay. Now, how are owners of S corporations paid? Payroll. We talked about this, right? Via payroll. You can use a major company like ADP, Paychex, Gusto, QuickBooks Online Payroll to calculate the paychecks and process the taxes. I recommend using a payroll processor. Doing it manually, it's a pain in the butt. Don't recommend doing it manually, but you can file Forms 940, 941, W-2, and whatever the state payroll requirements are for your state in a quarterly and in an annual basis. You can go online, you can go on the IRS website, you can search Form W-2, 941, 940. All the instructions are there. It is possible to do it manually. It's just a pain in the butt. So we recommend spend a little bit of money and use a major payroll company to just kind of take over that responsibility. Tax accountants do that too, but most tax accountants end up also outsourcing it to one of the big ones because it's just a lot of busy work, and it's very difficult to make money as an accountant for charging payroll. So the big payroll companies figured out how to make it really easy for small business owners. Now, after reasonable compensation is met, that means via payroll, you pay yourself a reasonable amount. Any payments or additional money you pay yourself as an LLC owner, that's an S corporation, or an S corporation itself, any subsequent payments to that are just owner draws, are just shareholder distributions, and they don't get self-employment tax. They don't get taxed. All the rules that we talked about of owner draws apply. Now, what about loans to shareholders? That gets a little bit trickier. With S corporations, they can lend the business owner as much cash as possible in the short term, as long as the business owner pays it back, usually within the year. That's what short term means. But if the LLC or the S corporation pays the shareholder or gives the shareholder a loan, and it's a long term, generally we're going to accrue interest. So we're going to calculate what the market rate of that money is, calculate interest. The S corporation or the LLC elected as an S corporation has to report the interest income, even if they haven't received it. They have to accrue it. And then if they don't do that, the IRS might change the classification from loan to distribution, and you can run the risk of your capital accounts being negative and having a different tax effect. Now, what are the pros and cons of doing payroll? Again, most people want to avoid it, but what are the pros and cons? So the pros is the portion of the payroll, the portion that you pay yourself beyond payroll or not in payroll will not pay self-employment tax. So you're only going to pay self-employment tax on that payroll portion. Also, payroll is a really simple mechanism that allows you to pay taxes along the way. So it allows you as the LLC owner, as the S corporation owner, to start putting money or tucking money away through a simple mechanism of withholding the tax and paying it to the government. Some of the cons is that it's more administrative expense, right? You have an S corporation or an LLC converted to an S corporation, you have to run payroll, pay a payroll service, withhold tax throughout the year. Whereas with a single member LLC or multi-member LLC, you don't have to do any of that. And you don't have to pay the payroll costs. You just have to make the estimated taxes the way we spoke about. Now, the last entity type here is an LLC that elected to be taxed as a C corporation. Now, this one's quite different. Most C corporation owners will still pay themselves a reasonable compensation and follow the S corporation rules of reasonable compensation, but it is not required. So even though most people follow it, it's not required. So you don't have to pay yourself payroll as an owner of an LLC converted to a C corporation or a C corporation. Why is that? Because if you buy stock in the stock market from a C corporation and you're a shareholder, you don't have to take payroll. They will never give you payroll. They will only give you a dividend. And that's what you call when you take cash out of a C corporation that is not payroll. So owner's draw or distributions in the C corporation world is actually called a dividend, and that does have a tax implication. Dividends from a C corporation that you own are actually taxed at a long-term capital rate. It's actually a preferred rate. Now, there is a double taxation effect of C corporations. Basically, with a single member LLC, a multi-member LLC, or an S corporation, you don't have this double taxation issue. With a C corporation, you potentially do, because the C corporation will pay tax in their own profits, plus the dividends that are being paid to these C corporation owners will pay dividend tax in the owner's personal tax return. Okay, so the concept of a C corporation paying tax and the owners paying a tax on the dividends is often referred to as double taxation. Now let's talk about those dividend tax rates. They can be either 0, 15, or 20. And it depends on how much money you make. So if you look at the 2022 tax bracket, or I'll put, again, a link to all the updated tax brackets in the description below, you can get the most updated one and see based on whether you're married, single, or head of household, depending on your income, where you fall into. For example, if you see that 0 option there, and basically if you make less than $41,000 in 2022 as a single person, and the only income you had was dividends, you will pay 0 tax. That's what that means, right? Because you can still pay a tax on your regular job, on your S corporation, on your single member LLC, on your business. You can still pay tax through other mechanisms, but the dividend portion might be at a preferred rate like 0, 15, or 20. 20 is the maximum that you pay on that. Now there's a little extra tax you pay when you're a high earner, which is like an extra 3% of tax on your dividends. But we're not going to discuss that. That's a little bit more complex. So it could potentially be almost 24% tax on the dividends actually. Okay, so as I mentioned earlier, if you have an LLC converted to a C Corp and you pay yourself dividend, you have the option to withhold some tax, and that withholding gets paid and gets reported in a Form 1099 div. You don't have to do it. Most people don't do it. But if you do want to withhold some tax, so through that dividend, you are withholding tax, you're allowed to do that with a dividend for a C corporation. Now, based on what I told you, why would anyone choose to be taxed as a C corporation? It sounds like a really bad idea. Well, think about it. There could be multiple reasons. If you own a public company, or you have a public company, or your company is going to go public, you might want to raise capital. 99% of companies in the stock market are C corporations. It's the easiest, mechanically speaking, to raise capital with, because the owners of those corporations only pay that preferred dividend tax rate. Now, even though the corporation pays tax, most investors in corporations never really even see how much tax corporations pay. The only thing they see is, when I get my dividend, how much tax will I pay? So this being the best vehicle with the lowest preferred tax rate for investors, this is the preferred choice, C corporations, when you want to raise capital. Now, keep in mind that C corporations only pay 21% corporate tax rate. So if you have a taxpayer that's in a very, very low income bracket and they're paying, let's say, 0 on the dividend tax potentially, they're only going to be paying 21% on the corporate profits. Now you have to open up a spreadsheet and calculate how much income will I pay on my other, how much tax I'll pay on my other income, plus the corporation, add them together and figure things out. But there are situations where some low income payers actually do benefit net from a C corporation from a overall tax payment perspective. Now, what happens to foreign shareholders on a C corporation? Well, if a corporation pays a dividend to a foreign shareholder, they need to withhold 30%. So the multi-member LLC with a foreign shareholder is at 37% withholding, where a C corporation foreign dividend payment, it's at 30% withholding. So it's a little bit different. They're still withholding because they're foreign. Right? Now, I didn't put a slide on this, but what about foreign shareholders in an S corporation? That's not a thing. S corporations are only for US-based people. So you can only have foreign shareholders in a single member LLC, multi-member LLC, or a C Corp. S Corp will always be US-based people. Now let's talk about multi-entity issues. What if you have multiple entities and some of these entities are owned or set up to be owned by each other? So that's what we call structured ownership. So can a C corporation be the owner of an LLC? Yes, it can. And the LLC, whether it's a single member or a multi-member, passes through the allocated income, and ultimately the owner of that LLC, which is a C corporation, pays the tax. So just think about ignoring what happens at the LLC level, and it's the ultimate C corporation, the one that pays the tax. Now, can another LLC be the owner of a C corporation? Yes, it can. The corporation will pay the dividend, will pay the income tax, and then when the dividend is paid through that LLC. And if the LLC is a single member LLC or a multi-member LLC, it will pass it through the owner or owners, and the owners will ultimately pay that dividend. So it just passes through. There's nothing weird happens. Can an LLC own another LLC? Well, the answer is yes. And the tax rules applies to the ultimate owner of the LLC in the chain. So you can have 10 LLCs that own each other, but at the end, one of the LLCs is ultimately going to be owned by an individual person. So when that happens, that ultimate owner is the one that pays the tax. All the rules are the same. Can an LLC own an S Corp? No. S Corps can only be owned by individuals or trusts, and as I mentioned earlier, US No, S corporations can only be owned by individuals or trusts, and as I mentioned earlier, only US-based. Can an S corporation own an LLC? Yes, it can, and the tax rules apply ultimately to the owners of the S corporation. So you have an S corporation with multiple owners that owns an LLC. It could be single member, multi-member. Just remember allocating based on who the member is. Ultimately, the one that pays the tax is the owner of the S corporation. Can a C corporation own another C corporation? Yes, it can, and you're going to have multiple layers of double taxation. So it's probably the worst idea ever to have a C corporation own another C corporation. I'm sure there are some legal reasons why many structures are like that, but typically as a small business owner, that's not a structure that you look for anyway. So what's my recommendation? Well, number one, if you watch the whole video, thank you. That's my first recommendation is to watch the video. Watch it again if you need to. I will have in the description a PDF version of this presentation that's also updated. So as there's any changes in the tax law or any of the circumstances change, I will update that document. So whenever you watch this video, regardless of how far in the future you watch this video, you're going to download the latest version of that PDF, the ebook, let's call it that, of this presentation. And my second layer of recommendation is you take what you read in this video, you cross-reference it, you Google, you do your own research, go to the websites and see what jives, what makes sense to you. And then once you have both the contents of this video and your own research ready, go see a tax professional, go see a CPA, go see an enrolled agent. especially if there's tax questions, and say, look, this is my situation. This is the income that I have from other sources. This is the income that my spouse makes. This is where I am in my life. This is what I'm projecting my business to do this year, next year, in 5 years. Based on that, let's apply it. And then what would you recommend I do? Should I remain a single member LLC, bring another owner, be a multi-member LLC, convert to a C Corp, an S Corp, depending on everybody's situation. Trust me, that money will be well invested. Go talk to a CPA. Tell them I sent you. Anyway, I hope you like this video. If you like this video, subscribe to the channel. Go in the description to see all the resources. Make sure you hit like and add any questions in the comments. I'll do my best, and I'm sure our community here on YouTube will also do their best to help you out. Thank you, and I'll see you on the next one.